the biggest thing that they get is, hey, I don't want to start a plan yet because I'm saving up for a down payment for my first house. Agreed?
Makes sense to me.
Yeah. And so I think rule number one in understanding the 20% down myth to me is understanding first, the only reason people hear 20% down is because they hear that mortgage insurance is bad. Would you guys all agree with that?
Yes.
So mortgage insurance is bad. Why is it bad? So what they're told is that it's bad because it's a premium that they pay if they don't put 20% down. And that premium is something that just goes to the bank and it doesn't go to them. Would you guys agree with that? There you go. So anytime you hear, oh, something doesn't go to me and it just goes to like the insurance company and it's not for me, well, then that's bad. And if my uncle or my aunt or whoever is telling me that this is bad, I should listen to them. It's that simple. So I think all we want to do on this call in the next 15 minutes is just dispel several myths around mortgage insurance and putting down less, and also talk about some products where you don't have to put anything down, and really just uncover that, because that's the key for a financial planner to be able to then say to their client, listen, you don't have to save $60,000 to buy a $300,000 home. You could save as little as $15,000 and do this and still be safe and protected. So, Andy, first things first, mortgage insurance, what's your understanding of how it works and when it's necessary?
I always go back to like the origin story of PMI. Essentially, banks traditionally have always only lent up to 80% of the value of your home. And the reason for that is because typically if there's a short sale or a foreclosure or anything bad happens with that borrower, then they can pretty much statistically know that they're going to get 80% of that value. So they're going to sell short of the value, but they know they're at least going to get enough to pay the loan off. And so if you understand that and realize that 40, 50 years ago, when PMI started becoming a thing, the PMI companies essentially allowed banks to then lend more because they were insuring the extra over 80% of that loan. So I think if you understand the only reason why people are able to buy with minimum down payment with 3%, 0%, 5%, 10% is because there's that extra layer of insurance versus essentially having very, very little options to ever put minimum down. At 20% was the standard golden rule, which we know 50 years ago, house prices were lower, 20% was more attainable. It just the industry was different versus now where minimum down payments is more the regular that we see, especially with first-time home buyers.
Yeah. And normally when someone is told something and then they never really look at the numbers, when you break down the numbers of, hey, you could go back to 2015, you could go to 2018, you could go to 2020, you could go to 2021, and you look at, hey, if you had entered here and put 5% down versus you keep saving and renting, I think statistically there's no way, minus maybe some areas where values have gone down, and I don't know where those areas are, that it would have ever been worse to jump in. Now, with PMI, you talked about the origin. Aaron, real quick, explain what, when you have a lower credit score with PMI, like what that does to the factors and the rates, and how like maybe the stigma still exists to this day versus like people with 780 credit scores.
Yeah, so I think it definitely is credit score driven. it's effectively a mortgage insurance rate is determined. So it's very dependent on credit score. So typically for lower credit scores, meaning anything under 700, under 680, then you start looking at the different types of mortgage insurance, like PMI, which is private mortgage insurance, which goes hand in hand with conventional loans, and then government mortgage insurance, which is FHA, VA, USDA. So typically generally for lower credit scores, anything under 700 to 680, it's going to probably make more sense from a mortgage insurance perspective, along with an interest rate perspective, to go to one of those government loans. So,
right. And it's just like this. If you're watching this and you sell insurance and investments, on the insurance side, when there's a riskier client, the premiums go up. You can get insurance for a smoker, they just pay more. So credit score drives that the mortgage insurance premium. And when people have an 800 credit score, they can put 5% down and have a mortgage insurance premium of less than 20 basis points, or 0.2%, 0.2 of 1% add-on to put 5% down. So this is where, like, the modern credit score phenomenon for the younger clients, if you can get them early in the process, and they said they wanted to invest and save 20%, and you said, no, I want you to talk to our mortgage people. They can definitely show you what your credit scores are and a good comparison. And we get somebody with, let's say they had a 680 score, Aaron or McCain, and we knew that they could pay off credit cards or something that they were keeping that was stupid, and all of a sudden go to a 760 and get way better mortgage insurance and better mortgage rates. Then that's the kind of thing, guys, that when you are getting this objection in your fact finders, you have to uncover this and be able to explain this. McCain, I know you're new. I guess I'm trying to think of a lob ball question here for you that would involve, well, it's funny, when you started with us, you had been in a call center. Were there a lot of people that would call in for stuff and want to avoid mortgage insurance? Or tell us your experience quickly on that.
Oh yeah, I mean, people know about mortgage insurance, but they know the part, like you were saying, where someone in their family had told them, mortgage insurance isn't good, you need to get rid of this. So when I was working with a lot of refinancing, it's like, hey, you were in this conventional loan, but now you're under 80% LTV, and like you can get your mortgage insurance taken off. So that was a big hit with those kind of clients, just refinancing under 80%, because that mortgage insurance can fall off.
Right. And there's
my experience with.
Yeah. And there's a huge thing. One of the advisors we helped with his loan just got PMI dropped. He's only owned the home for 2 years. He put 5% down. And then with the servicer, he didn't refinance the loan because obviously rates are higher today, but he got the PMI dropped. They came out and did an appraisal, and the PMI premium was $180 a month. And so inside of 2 years, he put 5% down. He'd only paid the principal balance down, call it 15 grand, which, by the way, wouldn't get him out of the 80% from the original purchase price, but they came out and reappraised. His value was up $140,000 in 2 years. Crazy. And he's out of PMI now. And there's no way the bank can ever go back in and add it back in. So one of the other big things that I think, and this is kind of counterintuitive, is that when you put down 15, 10, or 5% versus a loan with 20% down without mortgage insurance, Fannie Mae, for all banks and lenders, gives the base interest rate for a loan with PMI 1/8% less rate. Here's the rate for a 20% down loan, and then the 15, 10, and 5% down loan have 1/8% less interest rate. Yes, less. Why do you think that is? Andy, you want to answer it, or Aaron, or McCain?
Yeah, it's because with that extra layer of insurance essentially protecting their liability, they're offering better terms, lower rate.
And here's the other reason. Most foreclosures happen in the first year of the loan. So an 80% loan that when they study the statistics of foreclosure, that the client put down 20%, but then they go bankrupt and they can't make the payment in the first year, that bank typically is going to lose money versus an 85% loan, right? That could go bad in the first year. And then the mortgage insurance protects the bank. So it's kind of counterintuitive. The first time I saw it years ago, when a client said, oh, I want to put down more to get a better interest rate. And then I did like 10% pricing and then I went to 20 and the rate was worse. I remember picking up the phone and calling my secondary pricing desk and saying, hey, what's wrong with the rate sheet today? And they were like, no, that's right. The 20% down is worse. And it's a huge thing out there that I don't know. I feel like not a lot of people talk about it. So we're 21 minutes or we're 10 minutes in, or how many minutes? We're 11 minutes in. I don't want to make these too long if we cover all the basics and, so people can watch. If you guys feel like outside of government loans, like VA doesn't have mortgage insurance, but it has a premium that the veteran pays to protect, like to cover the life of the loan. FHA has pretty high mortgage insurance. USDA now has mortgage insurance. So the government loans have it too. And they're all typically less down payment driven. Is there anything we missed for an advisor to know how to explain?
I don't know if we missed anything. I have something on my screen where I can just kind of show what
pop it up.
Run of the mill person with, a couple with 740 or better credit. So this is just our mortgage scale here. And can you guys see that?
Yeah.
Okay. Mortgage scale, John and Jane Doe, 740 plus credit scores. So this is what we could offer that first time home buyer who's got the income and they've got the credit. So the first option here is the STAR loan. So STAR is going to be 0% down with over 700 credit. I just have some sample interest rates in here. And as Brendan said, so we got STAR, we have another kind of hybrid loan that we have 5% down, 5% and then 20% down conventional. So this first column here, STAR, it's obviously a very competitive product because there's no MI and they can put 0% down. It's kind of in its own ballpark. Not everybody's going to qualify for that. Our second one is going to be a 15-15 ARM. So this is not a 30-year conventional. This is a 15-year fixed, adjusts after 15 years, fixed for another 15. The idea here is that you have a loan that's fixed for 15 years. You're likely not going to have this loan past that. And even if you do, if your rate's around 6%, you can always let that adjust and potentially go down or you refi. So 405% down, $20,000 out of pocket. You go down and look at the payment. This one also does not have PMI. So we have options without PMI that you can put as little as 0 down. I mean, when you grasp the competitiveness of that and how that opens up the door for a lot of buyers that are not connected with our product, wouldn't be able to afford that purchase price. It just shows kind of the
well, and this, Andy, for the planner who their client might have a 2-year window or a 3-year window to buy their first home, this shortcuts everything so that the planner can basically say, hey, we've got a source, we've got in our network, go meet these people. They might have a loan that could do this, and you could be in a house in 90 days, right?
Right. And the big thing here is you look at the bottom line, cash needed to close. I mean, you're just shy at $10,000 on a $400,000 property here, rough estimate, and then $30,000 with 5%. Both of these options are essentially right there. Like, what could you do with an extra $20,000 and buying sooner rather than later, building equity sooner, essentially keeping the liquidity there so that they can achieve their other financial goals like life insurance, other investments, that type of thing. Got it. And then just the last comparison is going to be these last two columns.
Go back up a little.
Yeah.
And that's just the standard 5% down versus 20. There you
5% and 20% down. As you can see, there is $79 per month of mortgage insurance on the 5%, right? Because you got to pay it if you're getting a conventional loan. But like Brendan said, the interest rate actually is a touch lower on a 5% versus a 20% because there's extra insurance and protection for the lender. The payments, obviously lower, but you're the bottom line really is where the rubber hits the road.
Yeah,
30
and you,
grand out of pocket versus 90.
and you used 0.25% PMI premium in that
Correct.
scenario.
Yeah,
Yeah.
that's one of my summary points, Brendan, would be, I mean, it's ridiculously inexpensive. 79 bucks a month.
Well, if you're, and again, if you're a planner looking at this, if you can save 1/8 in interest on the big loan, but you pay a premium, you pay a premium of 0.25% on the PMI, effectively, you're paying 1/8 worse, but look at your out of pocket. Your client gets to keep, what is that?
60 grand.
60,000.
$60,000 working for them somewhere else. And if they're, you know, from a tax standpoint, they can deduct the PMI premium if their income isn't. I think that still exists.
Yeah, 125,000 household.
There you go.
Take under that, you can deduct the PMI and save on your taxes.
Great. Good. Hey man, this is awesome. If you want a scenario like this and you're watching this, we can send this to you guys. Any other questions? Aaron, McCain, Macy? No?
I think so.
I think the bullet points are: get educated. It's not as it's relatively inexpensive, and it's not forever if it's on a conventional loan.
Yeah, you can drop it much quicker than you might think.
Right.
What Brendan was saying.
All right. Well, I'm going to stop this video. It'll record it. We'll get this out to the guys that want to see it and gals. Again, next week's call, don't know the topic. But yeah. Part of the real estate series that you guys need to know about and how to answer these questions. We're going to continue each Friday at 10:30.
Yep. Next week, we're going to talk about what the lender is going to look for when applying for a mortgage.
Okay, cool. And what they need to be able to tell their clients to kind of prepare.
Correct.
Awesome. See you guys next Friday.
Thanks, guys.